tricky area in financial reporting are sales of long-lived assets, impairments, and restructuring. And what makes these tricky is that they're on income statements and they affect the balance sheet, but they don't have a long-term effect. And when we're looking at an income statement, we're always concerned about operations and what's likely to continue in the future. So certain things happen once, and that's it. And those are things where we really want to disregard them because they're not likely to affect what's going to happen in the future, or they may push things in the opposite direction during the future. For example, restructuring activity is a big expense. And basically what you're doing is you close a factory, you fire all the workers, and you give them extra pay and all these other costs, right? And then you don't have those costs anymore. So right now your costs are going to be higher because you have a restructuring activity expense. But in the future, your expenses are going to be higher. So what we're really interested in the future. So when we look at a restructuring activity cost and it lowers income, then we want to celebrate that because next year's income is probably going to be higher. Not only because you're not going to have this restructuring cost again, but also because now the rest of your expenses are going to be lower. Now, the gain or loss on sale of any tangible asset is going to be the amount of money you receive, the proceeds, minus the net book value of the asset. And again, remember what the net book value of the asset is. It's going to be the acquisition cost minus accumulated depreciation. And when you sell it, you take the asset off your books, you take the accumulated depreciation off the books, and you record the gain and loss into income. So for example, Hilton sold this hotel for $1.95 billion. They recognized $143 million gain. And they would record a gain on sale of $143 million. That would be the total amount of the gain, minus whatever they would have to pay for taxes. Another issue is what we call impairments. And this is something that we don't talk about usually in the first accounting course, but it's extremely important. If you have property, plant, and equipment, any long-lived asset, you have to periodically take a look at it, at least once a year. Take a look at it and make sure that it's still worth at least its book value. Because what could happen is that the value of that asset could drop and it's no longer worth its book value and you can't overstate the value of the asset on the balance sheet. So the way that you would perform this test is you would estimate the total cash flow from that asset, total future cash flow that you expect to receive from that asset, and compare that total future cash flow with book value. What's interesting is that you don't take the present value, you take the total value. If the total value is less than book value, then you have what's called an impairment, and then you needed to write it down to its fair market value. But as long as it's above book value, you don't have an impairment and you don't have to do anything. Now this leaves the company a certain margin of error. So when you think about it, adding up all the future cash flows doesn't really make sense. And you learn in finance class you're not supposed to do that. So that would give you an inflated high number because dollars in the future are worth more than dollars now. That's built into this because we don't want an impairment to be recorded every time something decreases in value. We only want it to be recorded when the decrease in value is significant. So here's an example. Chesapeake Energy had to write down its oil and gas properties in 2015, recording what was called an impairment. They have oil wells. The price of oil has gone down, and therefore these oil and gas properties are worth less. They looked at the total likely cash flow from these oil wells, and they determined that they were less than the book value, so they had an impairment. They wrote them down to the fair value, and that resulted in an impairment loss of $18,238,000,000. Now, the way we would look at that as analysts, interestingly enough, is we would ignore it. Because an impairment charge is a one-time event. Once you've written it down, you're not going to have to do an $18 billion one every year. It's not like when you sell stuff, right? Every year you sell more stuff. You do an impairment once. and you're not likely to do it again unless the value keeps going down even further. If you expect the value to keep going down, you've got to impair it even more the first time. So this impairment charge is a one-time thing, and it's something that we would not pay a lot of attention to. And then there's restructuring. And we've talked about restructuring briefly before. And a lot of times what companies will do is they'll close down parts of their business on the assumption that those are parts of their business are kind of dragging down the rest of the business. This relates to what I was talking about, turning over your inventory. Really all assets are like that. You got to use your assets. Your assets are there to help you make money. And sometimes what happens to companies is that there's just too much assets and they don't need them all. So I'll give you an example. Right now in 2018, one company that's had a lot of restructurings, every year they have restructuring, is Sears Kmart. They're both owned by the same parent, Sears and Kmart. And so when they look at their business, they're looking at all these huge stores that just don't sell very much stuff. So it doesn't make sense to have a money-losing store, keep a money-losing store open. And from their perspective, the smartest thing to do is close down the store and get rid of that investment. So they would close down the cost. When they make a decision to restructure, they would close down, make a decision, they're going to write off whatever they have to for the store. Maybe they'll sell the real estate at a gain, lay off the employees. They might have to pay the employees some kind of severance or relocation costs. We'll talk about that. They have to estimate all that cost and any other costs that are involved in this restructure. Now, this is a little different from discontinued operations. Discontinued operation would be when you sell a whole segment of your business. Restructuring can be any size piece of the business at all. It can just be a store. It could be an office location. It doesn't have to be earned revenues and expenses. It could just be a piece of the business that they decided to close or to reorganize. So what the company needs to do is it needs to estimate the cost of terminating or relocating or whatever employees. There's a severance expense or something like that. And these would need to be the total cost, not just this year, but forever. How much is it going to cost to lay off this employee? And they need to record that as a cost now. They'll create a liability for it and slowly work down that liability as they make the payments. So here you can see employee termination costs and exit costs. And what happens is at the beginning of the year, this is Pfizer, they had a liability of $1.685 million. It's a lot. They added $68 million to it, but then they paid off, meaning really that they gave the money to the employees, $639, and then by the end of the year it was reduced to $1,114,000, and so on the following year. They also have an accrual for exit costs here. I'm sorry, an accrual here is the total amount, that's the liability that they have on their balance sheet. Now, sometimes companies fool around with this, and they need to book a liability. Sometimes the liability is too high. Sometimes the liability is too low. And if the company can't estimate it accurately, then that may indicate that there's a problem. So if a company estimates it too low and they have additional costs, they might have been really trying to increase income. What companies could also do is they could decrease income on purpose. Because what could happen is if you record a huge restructuring liability and you fire all these employees, then when you have future expenses, they can come out of the liability and you don't have to book. They've already gone on the income statement. So reporting lower income now would allow you to report higher income in the future. And it goes in the other direction too. So this is something to keep an eye on. How well do companies estimate their restructuring costs? And we want to look at asset write-downs, because if you write down an asset, that reduces the depreciation expense, and that reducing depreciation expense increases income. So writing down your assets might lower your profits now, but it's going to increase your profits later on. again, writing down the asset would reduce the cost, and reducing the cost of an asset reduces the depreciation. So an impairment actually could increase future profits. Just pure paper. When we look at write-downs, therefore, and by the way, there's a trend that when a company changes management, a new manager comes in, they usually have a restructuring and they have a lot of impairments. It's just, research has shown this. So it's a trick, because what you do is if you impair a lot of your assets, the cost of them has been written down, and therefore the depreciation expense is going to be lower and profits are going to be higher. So that a write-down now will create profits in the